where do you start your investment journey if you're keen to invest in unit trust? So here you are saying, today I want to invest in a money market fund. I would want to invest in a bond fund. I've never done these investments. How do you earn a return, or how does your money work for you while invested in the money market fund? You earn interest, and the interest is earned on a day-to-day basis. So if you consider having money in a bank account, current account, earning you zero every other day, if that money was invested in a money market fund, you'd be earning a return on a day-to-day basis. So inflation will always eat into your money. As long as your money is not growing, or even if it's growing and it's growing at a rate that is lower than the inflation rate, that means your money is losing value, right? My name is Rose Motiso. I'm with business development with Britam Asset Managers. Investments is all I've known my entire working life, to be honest. Having joined Britam quite young, straight from university, and gotten into this world that, to be honest, I never had any interest in. To give you context on how uninterested I was in investments, I was those kids when your parents would be watching news, then it gets to the business section of the news, and then they are there monitoring what are their share prices, what are the share prices for Kengen, and my parents were very keen to see how the shares are performing. I would be so bored and wondering what time will this news come to an end. And then I end up coming straight into that, into investments, an area that I had never really focused. So it's interesting, to be honest, and it's been quite a journey for me. That's what I'd say. I've really learned a lot over the years working with Britam, and generally just getting exposed into the investments world and getting to understand how to have your money working for you. Because at the end of the day, is having, when you're doing your investment, is having your money working for you at any point in time. So I'm happy to be here this evening. And for now, for the next section, I'll get started by just highlighting the types of income that we know, or we might have come across. So ideally, we do have two types of income. We have active income and passive income. Active income is what you wake up to do, is what you earn through what you wake up to do on your day-to-day. So probably you're employed, you earn a salary, you have your monthly paycheck, you run a business, you make profits at the end of the every often as you run your business. You do consultancy, you earn your fees or your professional fees, you're in sales and you earn commission. So ideally what it is that you wake up to do actively every other day to earn an income, that's what we call, that kind of income is what we call active income. On the other side, passive income is ideally where now your money is working for you. You are not directly involved. What you've done is you've earned your money through your active day-to-day business or ideally employment, and then now you have avenues where you've invested your money and the money is earning you extra income up and above what you've invested. So that's what we call passive income. So here we have investments, for example, what we are going to look at today, investing in money market and bond funds where you earn some interest. Probably you're investing with government in government bonds, you're getting your coupons every other 6 months. You've bought shares, and then probably the shares that the companies you've invested with are paying you a dividend every other year. You're a member of a SACCO, right? So you do have some savings with your SACCO, and your SACCO is paying you a dividend every other year probably. So passive income is ideally your money working for you as you sleep. So you know you're sleeping and you know your money is growing every other day. So today we really want to delve deeper and see then how do I have my money working for me as I go about my day to day, and as I look at how then do I continue and how do I keep making sure that I'm growing my income on the active side, and then on this other side I'm engaging professionals. I've given my money to individuals who ideally understand how the investment world works, because the truth is we'd all want to be jack of all trades, where we have what it is that we do on our day-to-day basis, and then at the same time we would still want to be able to know where do we invest, is this a good investment opportunity, and there's so many investment opportunities out there. So just to be able to separate those roles, I think what we recommend is focus on what it is that you do best day to day, and then have your money working for you and invested with professionals that understand what happens in the investments world, and they're able to exercise prudence, integrity, and do research ideally so that they can have your money growing for you every other day. So one of the measures of having achieved, or how you can be measured as having achieved financial freedom, is how when you get to the stage where your passive income is actually more than your active income. So when you get to that point where you have investments that are really earning you more money than probably your job, probably your business, or probably your what it is that you do on a day-to-day basis, then that's one of the main measures of having where you can be said to have achieved financial freedom. So I think the main message for this session is we should target to ensure that we achieve to earn as much passive income from our money at any point in time, and not having our money sleeping, just sitting idle in bank accounts, or keeping money in the house, not earning anything if there's opportunities out there. So money market fund and bond funds that we are going to discuss today fall under what we call unit trust or mutual funds, right? So you might have come across that term, either mutual funds or unit trust. So I think it would be ideal for us to just look at what exactly unit trust means and what it entails, and then we go in, and then now we get into looking. We delve deeper into now the money market fund and bond funds, which now fall under this category of investments. So, what a unit trust or a mutual fund, or ideally also called collective investment schemes, what these are is ideally pooled investments. So just to make it simple, think of it where we have a basket, right? So we have a basket here, and then different individuals contribute funds into this bucket. So we all, put in our amounts, the various amounts, and then at the end of the day, all the contributions that are made into this basket, they are invested, right? So that's what, think of a unit trust as that, contributions into a pool, and then at the end of the day, what's contributed in the pool, the money is invested. So the question is, who does these investments on your behalf? Or ideally, which entities will offer you unit trust investments? So the entities that offer unit trust funds are called fund managers. Britam Asset Managers is one of them, and we have quite a number in the industry that you've invested with, or you might have come across as you do your investment research and look around ideally on where to invest. So, so there's various unit trust funds that we have in the market, and just generally in Kenya, unit trust funds and mutual funds. So what you will commonly find within Kenya is money market funds, which I think are the most common. Most of us have probably invested in a money market fund. And then we also do have bond plus. We do also have bond funds. We have balanced funds, and we have equity funds. So those are the four options that you will ideally, if you're keen to invest with a fund manager, or you're keen to invest under a unit trust, then those are the four options that you're most likely going to find across the various unit trust options we have in Kenya. So maybe just to mention lightly on what the other two entail, because for this session, we'll talk more about money market and bond funds, just in passing, so that we can have an appreciation on what the other two entail. So equity funds, ideally, like the name suggests, an equity is a share. So if you're investing in equity funds, it means you're investing your money in a pooled fund that will have your money invested in the stock market. So quite high risk and very volatile in terms of returns. I think we appreciate how the stock market operates. And I think Baraka has already alluded to the fact that risk is one of the areas you would really want to make sure that you understand where you lie in terms of risk appetite, so that at least you are able to absorb any shocks that come through investing in equity funds, and ideally any other high-risk investments that are available out there. So if you're keen to invest in the stock market, but you're a busy individual, you do not have the time to find out, should I be buying Safaricom shares? Is KQ a good option? Should I be buying KCB? Is the banking sector doing well? And so on and so forth. You leave that job to the professionals. Invest, just pull your funds within an equity fund, and the money will be invested in the stock market. And then you have balanced funds. So balanced funds, like the name suggests, it's a balanced portfolio, right? So you're an investor, you like playing safe, but at the same time, you do not mind taking a risk. So you're in between. So this is a kind of investment that will have your money exposed or invested in across all, I'd say, asset classes. So you have your investments exposed to the money market instruments, the bonds and the treasury bills, and then you still have part of your money exposed to the stock market. So at any point in time, you have your funds exposed to all these asset classes. And then now we have the what we call low to medium risk investors. Conservative, you want to play safe. You want to make sure that what you've earned through your hard toil Monday through Friday, that is at least number one, stable, but you're also keen to have your money working for you and earning you something extra. So that's where now the money market and the bond fund comes in. So that's what unit trust ideally means, or mutual funds, just to have an appreciation of that, even as you now go into looking into what the money market and the bond fund entail ideally. Another thing that you would want to do as an investor, currently maybe you've invested or you are a potential investor and you're wondering, I've heard so much about money market funds, I've heard so much about mutual funds, but I'm confused, to be honest. I don't know where to start. There's so many fund managers in the industry today. I think we've seen over 30, and they all have investment options for you. So probably there's that confusion. You're wondering, where do I start in terms of doing my due diligence? Because at the end of the day, I think we've already we all want to sleep, right? You want to sleep comfortably knowing, as much as my money is working for me, at least I know my money is invested with an entity that I'm comfortable with, and it's an entity that's been tried and tested over the years. It's a stable business, and they've been able to offer these investment options for a long period of time. So what we are looking at here is ideally the stakeholders you need to look into, even before you go and look for 9%, 10 or 15%. So when it comes to the unit trust or the fund management industry world, ideally, we have stakeholders that come work together just to make sure that at the end of the day, what it is that you're looking at or what it is that you're targeting as an investor is delivered to you, and delivered to you in the most prudent way, and observing integrity as much as possible. So where do you start your investment journey if you're keen to invest in unit trust? So here you are saying, today I want to invest in a money market fund. I would want to invest in a bond fund. I've never done these investments. So where you start is, number one, you identify a fund manager, right? So you have the fund manager that will offer you the investment opportunity. So once you know who the fund manager you want to invest with, and it doesn't have to be one, it can be 5 fund managers. You do not have to really tie yourself to one investment manager. So once you know who your potential investment managers are, the next thing is to confirm they're regulated by the Capital Markets Authority. I think regulation is important. At the end of the day, in everything that you do, you want to make sure that there's someone or there's a body overseeing the kind of investments, or ideally how the investments that are being done, and there's someone regulating and making sure that there's principles that govern and policies that govern the investment. So make sure that the fund manager you're looking at investing with, number one, is regulated by the CMA. How do you do that? Go to the CMA website. They have a list of all the fund managers that they regulate to offer unit trust. Besides that, now comes another stakeholder called a trustee. So the trustee is the entity that will make sure that your interests as an investor are being observed and protected. How? So trustees make sure that the fund manager is investing the funds in accordance to the policies for the various funds, and they make sure that ideally they have oversight of what the fund manager, the business the fund manager is doing, and how the money is being held by the custodian as well. So you want to confirm who the trustee for the fund manager or the investment manager you're investing with is, because at least, again, you'll be able to sleep even more knowing that there's someone that is also, besides the regulator, there's someone now who's actually overseeing the day-to-day activities and investments that are being undertaken by the fund manager. And then finally, we have the custodian. The beauty about this industry is fund managers are not banks. They do not take your money. They're not deposit-taking institutions. So when you want to invest in a unit trust, any of the funds that we've highlighted, what happens is you will go, they will tell you what the process is, and then when it comes to depositing the money, they will refer you to a custodian. So a custodian is banks that we all know of, just local banks that hold the money on behalf of you as the investor and on behalf of the fund manager. So once they refer you to the custodian, you deposit your funds with the custodian, and then the fund manager will do the business of investing. So here there's a separation of roles, because you have the fund manager whose job is entirely to invest the funds on your behalf and earn your return. And then we have a custodian whose job is to hold the money, and as well as making sure that the money is goes to where the fund manager would want to invest, and so on and so forth. So these are stakeholders you want to make sure that you understand and appreciate even before you go confirm that the rate is actually 12, 13 or 17%. All right, so coming down to money market and bond funds. So we'll start by just looking into what money market funds are. And to make it simple, and maybe just to start with a comparison, A money market fund is ideally your bank account, right? So you have a bank account where you keep your money for whatever reasons. Probably you keep money in the bank for safety, because ideally, if you compare walking around with cash or keeping money in the house, it's safer in the bank, right? But I think safety with banks is also relative, because we've seen what's happened to some banks in the recent past. So probably you keep money in the bank for safety. Another reason you could be keeping money in the bank is because you can easily access it whenever you need to access it. So, and it's so easy nowadays, we don't even go into banking halls anymore. You're able to do your online banking, you're able to do your mobile banking and transact at the convenience of your digital, of the digital platforms and your gadgets, wherever you are. So accessibility, at least that's a guarantee, as long as you have your money in a bank account. And then some of us, not everyone, have money in a bank account that could be earning interest. So interest is ideally pegged or dependent on the kind of type of account you hold in the bank. And what we see as a fund manager, or what we see in this industry, is most Kenyans toil hard every day, look for money, then go deposit money in a bank account, more specifically a current account that earns you zero. Right? So you're there paying your ledger fees, you're there, your money earning zero, losing value because inflation is still there at the end of the day, but you still work hard because you need more and more money. So any prudent individual or anyone out there who knows that inflation will always be there, money is losing value at the end of the day if it's not growing, then you would typically not have money in a current account sitting for more than a month, right? So you'd have money in your current account for your day-to-day probably expenses as an individual or a business. So money market fund is like that bank account. But what is the main difference between my bank account and the money market fund? So money market fund is a type of unit trust investment. I think you've already highlighted that. It's very liquid and open-ended, in the sense money market funds, the way they are structured, they're not locked investments. It's an investment option where you place your funds. The money will earn interest on a day-to-day basis, and the day you need your funds back, it's as simple as placing instructions and the money is transferred back to you. So it's not a locked investment. However, some fund managers do have a minimum investment period where they say, if you place your funds today, at least before you access, give it at least a minimum of 2 weeks or a month, and then from there you can be able to access the money. So it's not locked, but some of them could have a minimum investment period. So that's one of the things you need to find out as you go signing up for money market fund. Now, when it comes to stability in terms of your capital, money market funds come with that benefit of capital preservation. They are also very low risk investments, and they also offer diversification. Diversification is very key when it comes to investments, because at the end of the day, you want to make sure that you spread your risk, right? So how are money market funds able to achieve that capital stability? How are they able to achieve the diversification aspect? This is informed by where the money is invested. So the other thing you really need to understand and appreciate is find out where the money is invested, because it's one thing knowing your money is earning 15%, but it's one thing knowing it's earning 15% because it's invested in XY and I'm comfortable with where my money is being invested. So money market funds generally invest in an asset class we call fixed income. And fixed income is ideally what we consider low risk investments in the market. So we have quite an array of fixed income options in the market. We have investments with government, investments with banks, and we also have investments with ideally companies. So when it comes to government, we have treasury bills and treasury bonds, ideally loaning money to the government. We have bank deposits, that same banks that we all know. You go place a fixed deposit or a call deposit, and then you get a certain rate for that for the period the money will be invested. And then we have commercial papers and corporate bonds that are issued by private companies. Not always available, but as and when there's an opportunity and a good opportunity, money market funds are likely to subscribe to these investment opportunities. So if you look at those investments, number one, you'll realize there's nothing like shares. So money market funds will not invest in the stock market. Money market funds will not invest in real estate and the property and, such long-term investments. Because remember, at the end of the day, it's a very liquid investment. In the event you need your money, they should be able to give you and pay back your money as soon as possible. So that is what ideally informs the underlying investments, the risk involved, and ideally the stability of the investments that are undertaken by the funds. How do you earn a return, or how does your money work for you while invested in the money market fund? You earn interest, and the interest is earned on a day-to-day basis. So if you consider having money in a bank account, current account earning you zero every other day. If that money was invested in a money market fund, you'd be earning a return on a day-to-day basis. So that's one key differentiating factor between a bank account and your money market investment. So the interest rates will fluctuate daily. It's not a constant rate through the investment period. The rates will fluctuate daily, and that fluctuation is again determined by what are the prevailing interest rates, or ideally, where the money is invested, what rates are they earning, or what are those securities are offering in terms of a return. So how do you keep tabs in terms of the returns that your money market fund is earning? The easiest way is to check on the papers. One, it's a requirement by the CMA, the regulator, to have all fund managers to have their returns published on the papers. So one easy way is to just check the papers, Business Daily, The Standard, Daily Nation. You'll find the returns published there on a day-to-day basis. Another key benefit of having your money invested in the money market fund, and it's something we are going to look in a slide, we're going to look into in a slide coming up, is interest compounding. So besides having your money earn interest every other day, that 5-10 shillings you'll earn every other day or every other month, at the end of the month, that money will be compounded, meaning besides earning interest on your principal investment, you will also earn interest on interest. It's quite powerful, interest compounding, but it would only make sense if you would consider a longer term investment, and that we will highlight in, like I've said, in a slide coming up shortly. They are very liquid, like we've said, accessibility, the same way you want to access your money with no hitches in your bank account. Money market fund also offer that option. The only other thing is you need to understand and appreciate is, unlike a bank account where you'll do your mobile banking, have your money on M-Pesa and be able to utilize, money market funds, remember that at the end of the day, the money is invested. So if you place your instructions and you would want your money paid back to you, it's not instant. It would, on average, and if you look at how the industry operates, on average, it takes about 2 to 3 days to have the money transferred and paid back to you at any point in time. Charges, another thing that we never really get to look into. We go undertake investments, and then when it comes to now us getting back our money, we realize it's not actually what we signed up for, because we never really get to understand what are the charges of these investments, or what am I likely to incur as I go about this investment. So how money market funds work, there's 2 types of charges. There's a management fee, which is charged by the fund manager that is doing the investment for you. On average, if you look at across the industry, on average, fund managers charge between 2 to 1.2%. And then we have tax. KRA will charge tax on the interest that you earn, and that's called withholding tax, and it is 15%. The 15% is the same across the board. That does not vary fund manager to fund manager. So those are the only 2 charges. You'll realize that there is no initial fee, meaning there's no charge on your principal investment, and ideally these 2 charges are deducted from your interest. Now, why invest in a money market fund? And ideally, number one, I think we've already said bank account, I can access my money at any point in time. What we recommend is whatever you keep in your bank account, let that be the money you need for your daily use, for your weekly grocery shopping, if you're running a business, for your expenses, and so on and so forth. Money you need to utilize in a very short period of time. But funds that you're saying you're very deliberate and you want to save for a certain goal for a period of a month, 2 months, all the way to maybe probably 6 months, have that money invested in a money market fund. Number one, we've said inflation is there. Inflation will always eat into your money. As long as your money is not growing, or even if it's growing and it's growing at a rate that is lower than the inflation rate, that means your money is losing value. Right? So if nothing else convinces or motivates you to invest, just have your money invested somewhere where at least you're able to make sure that you're retaining the value of your money because of inflation. And then if you look at the returns that money market funds pay, they're quite higher, or they're better compared to what you would earn in a bank savings account. So a bank savings account will pay you on average maybe 2, 4, 5%. Money market, if you look at money market funds in the industry at the moment, most of them are paying somewhere between 9.5%, some even going all the way to 10, 11%. So money market funds are very easy to sign up. Just make sure that you have a separation of roles. This is an investment, and money in my bank is money for my daily expenses. Do not use your money market fund as a bank account where you're investing. After 2 days, the money is out. After 1 week, the money you will never really appreciate the value of the investment. Coming now down to bond funds. Bond funds, again, still fall under unit trust, like we've highlighted. they are more or less they more or less operate as the money market funds in terms of, if you look at where the money is invested, they invest in fixed income. But the key differentiating factor is in terms of the exposure, right? So you'll find money market funds have a limit in terms of doing longer term investments because of the liquid nature of the funds. But bond funds, because they are more of short to medium term investments, where we say invest for at least a year, so they at least they have that benefit and they're able to take advantage of longer term investments, for example in government bonds, and earn higher returns. So that's one of the key differentiating factors between money market and bond funds. But ideally, the way they are in the industry, they are open-ended and also quite liquid. So one, allow me to highlight about 2 or 3 benefits of investing in a bond fund. And what ideally an investor would compare a bond fund to is probably investing in government bonds or corporate bonds, right? So one of the key investments that we have in the market at the moment is government bonds, and we're living in such a time where Kenyans are really informed and they know they can actually invest directly with government, and there's all these opportunities that you have to even have your money growing and earning a higher return. So as we all know how bonds work, they are more of long-term investments, and then they will pay you a coupon every other year. Every other 6 months, you'll get some the interest paid into your bank account. But the main disadvantage with investing with bonds, I think we all know, is when it comes to liquidity or cashing in your investment. So bonds are long-term, like we've said, so it would not be ideal for an investor to have all their money invested in bonds, and then at the end of the day, for example, your emergency fund is in a government bond. Money you need to pay school fees in the next 6 months, you've invested in a government bond. So there needs to be a separation so that at least you have an appreciation on, if I need short-term investments, but at the same time, I also need long-term investments. So bonds are for your long-term investment options, and then the bond fund comes in for that investor who's keen to have their money invested in bonds, but the liquidity is key for them, right? So they want to ensure that as much as my money is invested in bonds, as and when I need my money, I'm able to cash in and request my money and get it back 2-3 days. I'm fine with that, compared to having to wait for a week or 2 to sell a bond in the secondary market, which comes with its own risks. So bond funds give you that benefit of knowing, yes, my money is exposed to the bonds, amongst other investments like bank deposits, because it's not just bonds alone. We also have bank deposits and commercial papers, but a bigger percentage of the money is invested in government bonds. But at the same time, I can access my money as and when I need it. So that will be able to help you achieve that liquidity. The other thing is, it is suitable for investors who are seeking regular income from their investment. So the same way you'd go to a bond, because every other 6 months you'll get your coupon, bond funds will still be able to pay you your interest on a month-to-month basis, or as and when you need your money, or as and when you need to access the interest or the returns you've earned on your investment. So they also offer, just like money market funds, they offer the benefit of interest compounding, meaning you're also earning extra up and above what you're earning on your principal amount. And then the charges, again, are more or less what you will be charged on your money market fund. On average, about 2 to 1.5% in the market, and the withholding tax remains to be the same. So bond funds have really come in to help those investors that are keen number one, to get a very attractive return, right? Something close to what the government will offer you. So it might not really give what the government is offering, 15, 16, 17%, but it's still a double-digit return, but with the benefit of liquidity and protecting you ideally from the risks that come with pricing and having to sell bonds before maturity in the secondary market and selling at a discount and so on and so forth. So coming down into look at now to see the suitability of these 2 options. So what is suitable and when is it suitable for me? Ideally, you'll realize the 2 options are suitable for you. It depends, again, with your risk profile and, again, the goal. I think at the very beginning of this session, Barak has already alluded to the fact that you need to have a goal that you're investing for, right? So depending, again, with the goal and how long you're looking at achieving the goal, that, again, also informs which product or which investment fund would work for you at any point in time. So if you look at the risk profile for the money market funds, I think we've already said they're quite low risk. And then bond funds are low to medium risk because of the most of the investments being done under into the bonds. which I think we all understand. In the event that interest rates continue going up, that means the pricing of the bonds is affected, and that means probably in the event you want to sell before maturity, there is a chance that you could sell at a discount. When it comes to liquidity, consider money market fund your very highly liquid fund, whereby if I need money, I can quickly access my money in a money market fund. Bond funds are liquid, yes, but the recommendation is consider a bond fund to be like more of a longer term investment compared to your money market fund. So money market fund is your typical very short term investment, anything a month to 6 months. Money market funds are perfect for that. But for those goals that you're saying, I think I need to save for another 6 months, another 12 months, another 2 years, 3 years for me to be able to actualize this goal, then a bond fund would be ideal for such kinds of investments. What we actually recommend, consider at least a year if you really want to earn the maximum return that the bond fund would be offering. But for money markets, anytime you feel you have money, yes, it's growing, it's working for you. But if you have a need, you can quickly cash in. Money market fund is that. So bond fund, be more committed, be more deliberate with that investment, because the return is quite good and you want to make sure that you get the maximum out of your investment. When it comes to the potential returns, money market funds in the industry at the moment are paying on average between 9 to 11%. Bond funds are paying 11 to 13%. So if you look at the return, bond funds are the return is quite higher compared to money market funds. Looking at how the interest rates are in the market today, we are seeing there's more appetite for the government to continue borrowing, and they're borrowing at quite high interest rates. It's quite expensive for them. So that means the interest rates continue going up for you as an investor. So if you're keen to invest in the bond funds, I think one thing you need to look forward to is at least a growing return, at least between now and the end of the year, as far as our outlook is concerned. The other thing is the goal, right? So what are you really investing for? So if you look at money market funds, again, it's more for your short-term, very, very short-term needs that you need to actualize in a period of a month, 2 months, 3 months, or 4 months. So I think top of mind is emergency funds, right? Living post-COVID, I think what is obvious and what we all know right now is we all need to have what we call a rainy day fund, right? You have a job. You could wake up tomorrow, you're on half salary, or that job, the job is no longer able to pay you that salary. So you're on a pay cut, So how do you make sure that you sustain your living standards? How do you make sure that if I lose my main source of income today, whether it's your salary, whether it's your business that you're running that's been making you profits, how do you make sure that in the event this is no longer coming through, how am I able to sustain my living standards and ideally for my family? Have an emergency fund. And it's recommendable to have an emergency fund that can take you through at least 6 months in the event your main source of income was to stop or will not be there today. So emergency money market funds are very good for emergency funds, because the main target here is you're looking at an investment where in the actual as the actual emergency happens, you're able to quickly request for the money and you're able to take care of the emergency. But the goal here is have the money at least invested in an avenue where you're earning a return, bare minimum, that outdoes inflation. So if you look at the inflation rate at the moment, we are at about 7.3 thereabout. So being in a money market fund that pays you 9-10%, at least your emergency fund, the money is not losing value, and the day that you need your money back, you're quickly able to cash in. What we also recommend is define what an emergency is to you, because I think things just come up and there's always need for money, right? So every other time there's always emergency. So make sure you define what an emergency is to you, or how an emergency looks like, so that at least by the time you're withdrawing money from your emergency fund, it's to take care of the actual emergencies that you've been saving up for. School fees, schools have just opened, very short-term investment goals. Working capital for a business, you have some money, you run a business, you have some money, you have $500,000, $1 million that's sitting in a bank account that probably you planning to, get some more stock for your business in a period of a month or so. Instead of having it sitting in a bank account, that money can be in money market fund. Holiday planning. I think we are approaching the holidays, November, December. So if you're keen to go for a holiday for the Christmas holidays, money market funds is really perfect for you saving towards that particular goal. And then we have life events. We have weddings. we are growing families, you know, we are starting families, we have all these things that happen as we go about life and as we grow as individuals, that demand that we have some money to be able to take care of that. So weddings, anything you're planning for in the short term, for a period of a month, 2 months, 3 months, a money market fund would be ideal for that. So money market is good for short term savings and short term goals that you're looking at achieving. Then now, if you look at bond fund, here now comes in your medium term goals, right? So you've already, you're now keen and you're saying, in the next 1 year, in the next 2 years, I want to own my home. In the next 1 year, I want to own a car, right? So probably you'll say you're looking into getting a loan or a mortgage, for example, to be able to own the home. So how do you at least work on raising the deposit that will be needed for you to be able to secure that the financing that you require? So the bond fund is ideal for that, because you can save consistently for a period of a year or 2 years, knowing that by the time I'm hitting year 2, I'll have raised my deposit. My deposit will have earned something significant that can help me take care of fees, for example, if it's the mortgage processing and so on and so forth. And then after that, you can withdraw the money, take care of your, get to be able to secure your asset and be able to achieve that. Project funds. So now you've already acquired your piece of land and you're saying, in the next 2 years, in the next 1.5 years, I want to develop my, I want to build my family home, or probably you want to put up a rental or a commercial property. So again, bond fund, very good for such goals for at least a period of 1.5, 2 years, so that you can be able to save deliberately for that particular goal. Sinking funds, I think Claire has already alluded to this. A sinking fund is ideally money you've set aside for expenses that you anticipate, right? So unlike an emergency fund, which is something that, yes, you know, it might likely, it's likely to happen, and you're protecting, you're ideally planning in advance for that. A sinking fund is ideally what you know that will happen. So for example, you have a loan that you're saying, I want to put some money aside to protect me, so that at least in the event I don't have any source of income and I have a loan that I'm supposed to pay back for a certain number of years, I have a fund that will protect me and will help me be able to take care of my debt. You probably you have a property, right? You have a commercial property that you need to maintain. You have some rental apartments somewhere that need maintenance. And I think these are the kind of investments that always need money. A tenant is moving out, you need to do repairs and so on and so forth. So a sinking fund is for such kind of expenses that you know will always happen. So you're preparing in advance for this kind of expenses. We have a reinvestment of your dividends and your coupons from your other investments. If you've bought your shares, if you've invested with your SACCO, you have your SACCO savings, and you're getting your dividends paid to you annually. One way to reinvest and have that money again working for you is consider investing in a bond fund. Every 6 months, you get your coupons from government bonds or corporate bonds that you've invested in. Another way to reinvest that money is considering investing in a bond fund. So at any point in time, just try and look. I have this sum of money. I think I'm very keen to have it invested or earning something extra from in an investment for a period of maybe 6 months to a year. Then that would guide you on where you'd be able to place it. Retirement planning and investment of retirement proceeds. If you're approaching retirement, you could be very deliberate and have a goal where you're saying, besides my pension plan that I already have probably with my employer, I also want to have some savings that will complement my pension, right? So bond fund would be a very good consideration for that, where you're saying, I want to be deliberate every other month, put aside some savings so that if I'm approaching retirement in the next 5 years, I'll have my pension and I'll still have my savings, X amount that together will be able to sustain me for a good period of time as I go about my retirement. And then the other benefit or the other thing you can consider investing in bond funds, again for longer, you'll find you can be able to go secure a loan from a bank or a lending facility. And then the advantage, how that would work is you'd have your money, you still have some money, but you want to get some kind of financing, for example, from a bank. You can have your deposit or your lump sum invested in a bond fund. It's earning you interest. And then you can use this investment as security to get that financing from the bank. So that's another benefit you would consider investing in a bond fund. And the benefit is you have your money working for you, getting you some kind of return. And this return is what you can actually use to comfortably pay back your debt, knowing that my money is growing and I'm able to sustain and pay back my debt as and when I need it. So bond fund has quite there's quite a number of goals you can save up for. Anything a year and above, bond fund would be ideal. But anything where you need to quickly access the money and take care of these goals and these kinds of expenses, then money market fund will be ideal. And then the other thing is affordability. Money market funds, generally, if you look at the industry, minimum is 1,000, very affordable. And for bond funds, at least 5,000 shillings, you can be able to open an account and get started on those investments. So then I think the question is, when it's all said and done, how do these investments help me achieve passive income? How do I have my money in a bond fund? And as I go about my business every other day, I know my money is working for me and earning me something extra for my future. So here comes in compound interest, right? The power of compound interest. And maybe just to start out with a quote from Albert, where he says, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it, right? So compound interest is ideally where your money is, the funds you've invested or your money is earning interest on interest besides your capital investment. Very powerful, but in the long run. So it accelerates the growth of your savings and investments over a certain period of time. So here is where the rubber meets the road. So here we are going to look at 3 individuals today and see if I really want to earn some significant passive income from my investments in money market fund, because probably you've invested in a money market fund or a bond fund, and the kind of returns you get on your investments are not really, you don't see how that money can help you earn something significant and some serious passive income in future. So the goal here is, number 1, start early, right? Start early. And number 2, have a longer term view, right? Rome was not built in a day. If you're really looking at growing your investments to a certain extent, then you really have to be deliberate and give it some time, because compound interest comes into play in the long run. So here we're going to look at 3 individuals who say, from today I want to be very committed, do savings worth 5,000 every month from my income, invest in a money market or a bond fund. Let me work with a bond fund, for example, and we are working with a very decent return of 9%. So you've seen right now we are operating in an environment where the funds are paying between 11 to 13%. But here we're working with a decent return of 9%. So we're saying these individuals are putting aside 5,000 every month, and we're going to look at 3 different times in their lives and see how this will be able to help them achieve passive income. So starting with a 25-year-old who says, from today I want to commit 5,000 per month to be able to enjoy the compound interest and earn some passive income, ideally from my savings. So a 25-year-old, by the time they're 45, which is 20 years down the line, in terms of total savings, they'll have saved 1.2 million. But that 1.2 million in return will have earned them 2.1 million in interest. So this 2.1 million is what we are calling the passive income. Their money has worked for them and earned them that kind of return. By the time they are 50, you can see the kind of money they're making. The return is actually almost 3 times the savings they will have made within the 25 years period. By the time they are 60, you can see the kind of returns they will be making. Look at a 30-year-old who only has 15 years by the time they are 45 years. So you see the savings are quite minimal, because again, time comes into play. And if you look at the return, is also more or less what they'll have saved, mirroring more or less what they'll have saved. Look at by the time they are 50, at least, because there they have the time. They've given it time for the power of compound interest again to come into play. And then look at by the time they are 60, they'll also have made some significant return on their investment. Look at a 40-year-old who only has 5 years, right? So they only have 5 years to save the 5,000. They'll have saved the 300,000. But look at the interest. So I think this is again to highlight the fact that if you look at the kind of returns you earn month on month, in the short term, you would not really understand how these kind of returns, will really make an impact or help me achieve my goals that I'm looking at achieving in the near future. However, if you're committed and deliberate, and remember, it doesn't have to be 5,000. You can decide to set aside 50,000 every month. It can be 100,000. At the end of the day, you know what it is that you want to achieve and the time frame that you're working with to be able to achieve that. So I think this is now demonstrate and brings out this aspect or answers the question, can I really earn something significant from my investments in money market, ideally a bond fund, something significant that I can say I'm earning some very good income on my investments in these investments. So I think this will be able to highlight this for you. Just be deliberate, right? I think Barack told us for him, he's committed to a standing order. He has a standing order where he knows every often I have some money that's going into investment. So consider setting up a standing order so that you don't have control where every month you are the one who has to initiate these savings. Standing order would be perfect to be able to achieve that discipline, especially. And number two, think longer. Think longer. If you can think longer, you should be able to achieve some significant income from your investments in these funds. And maybe again, just to, trigger our minds a bit further. So here's a story of 100 young people who are now aged 25. So we want to see how things will be for them 40 years later as they hit retirement. So by the time they turn 65, out of this 100, one of them will be rich. 4 of them will be financially independent. 5 of them will still be working. So you retire, you've hit retirement age, but you still work because you never made the right plans as you were, when you were young and you were able to work and you had the energy to put money aside and save and be deliberate about your future and your retirement ideally. 12 will be broke. 29, unfortunately, will be will not be there. And then we have 49 of them who will be dependent on friends and charity. And I think this is what we see in a typical African household, right? Where you retire, and now because you took care of your children, they went to school, they are now your retirement plan. They have to take care of your retirement and so on and so forth. So I think the message here is start early. And number 2, be very deliberate. Think about how you want to retire. How would you like your net worth to look like by the time you retire, so that at least you know what it is that you're working towards to by the time you hit your retirement age, and you're planning ideally well in advance.
For more information, get in touch with your financial advisor, account manager, or relationship manager.